Two. Welcome back to Small Plates, and this is a big, big day. It's Chapter 3, Cost Flow Inventory and Overhead. All right, I'm joined, as always, by my good friend, Professor Valentine.
Hey.
Hey, and Professor West is my name. And so we're trying to get you through this last piece of information for our semester, and hopefully this gives you some specifics on how to get through these kind of problems. First thing we did was we picked a problem out of the book. And so we picked 314 as the problem we wanted to work. It has all the major pieces of it. One thing that we did add was we added these two assumptions. We did that because we were wanting to also calculate or put together the income statement. And then these are kind of the classic questions that we tend to ask about this material. Eric, are those pretty much the ones that you focus on?
Yeah, sure, absolutely.
Okay. Is there any one of those things that you tend to find students have a harder time with?
I found that the over and underply, number 3, was a challenge.
Yeah, I find that's pretty confusing too. And so, we'll take you through that and make sure you pay attention to that one, because that one can come back and bite you.
Yep.
First, we've got a couple of things in problem 1, though, that we need to talk about. The first thing is making sure you can calculate a predetermined overhead rate. Now, I tend to call that a POHR, or predetermined overhead rate. What do you use, Eric?
I call it POHR as well.
Okay. So at that point, I start talking about the Statue of Liberty. Give me your predetermined overhead rate. All right. Now, the other thing we've got to recognize is it's built on estimates.
I tell my students estimates is a fancy business accounting term for a guess.
Yeah. All right. I like that. So this is another thing for guess. All right. So this is our best guess at the start of a period. So this is one of the things you do during that planning budget process that we talked about earlier. And then the activity, I always kind of find that hard to explain, Eric. Why don't you take a crack at it, and I'll follow up with something. What do we mean by the activity in the overhead rate calculation?
We have it has a couple of names. The estimate activity base, or cost driver. Basically, we have this big nebulous overhead, and we want to try to make it behave more like a direct cost. So we want to see if we want to find some kind of correlation between an activity and a consumption of overhead.
Oh, okay, that was really good. So you also mentioned the term correlation. I have said in class that the higher the correlation you get, the stronger the predictability of these two guesses, the way they work together. Now, you might also notice that Professor Valentine did not say causation. He just said, do these move together? So the higher the correlation, the better off we are.
Absolutely.
So you might watch for that. So in this particular problem, if we're going to calculate out the predetermined overhead rate, we can get there, right? Because we know, it said up here at the top that our estimated overhead was 800 and our allocation base was 500,000. But be careful, because this is direct material dollars. Now, Eric, I tend to use a lot of direct labor hours in my examples in class. Will this direct material dollar thing, is that going to affect me much?
No, it mechanically works the exact same way. You know, we talk a lot of.
I take that 800,000,
right,
which is my estimated overhead. Okay, and then in this case, they've told us this is direct material dollars is the relationship.
Correct.
So I just put the 500 in here, just like I would a direct labor hour.
Or a machine hour, yeah.
Oh, that's a good one too. So a machine hour is another one that we hear. So we hear direct labor hours a lot. We get machine hours a lot. So there can be a variety of them. But as Eric was saying, he's trying to find an activity that correlates highly with overhead. So at that point, it's just a straight calculation. You get $1.60 is your overhead rate, which essentially means for every dollar of material I use, I expect to use an additional $1.60 in overhead. Is that fair?
That is correct.
All right. Next big thing to remember is, how do I get applied overhead? And as Eric was saying, this is ultimately a big guess.
Right.
And in my own accounting terminology, to make it sound better, I call those the original assumptions. Okay. The original OA, starring Tracy Morgan. And so this gives you the applied overhead. If you just take that predetermined overhead rate times the actual, and what would be the actual activity here, Eric?
That would be, in this case, that would be material costs.
Once again, whatever you got in this previous slide, direct material dollars, okay, it's what you're going to use over here in actual. So in this case,
pay special attention to the fact that that is the actual activity. I've seen where, you know, some students will not have the actual activity; they'll have the estimated activity, and you're just getting the same thing over again.
So let's actually look at those numbers then, Eric. So
okay.
In this case, the actual direct material dollars were $450.
Correct.
And so what you're saying is, I need to use that actual, but over here, I had an estimate of 500,000.
Exactly.
Okay,
yeah.
So we need to be really careful there. All right. And so then we still got the $1.60 was our predetermined overhead rate. So we wind up with 720 as applied overhead. Okay. So if you think about the base formulas, those are kind of the two underlying formulas that we're going to have to deal with. And at that point, I'm going to try to switch over to my Excel file and see if I can see if we can work and take this thing on through the finish of the problem. Okay. So once again, the problem is set up here. And this is the mechanics of how I go about it. The items in black are given to you in the problem, and the ones that are grayed out are the answers. But it's basically to remind Eric and I what the real answers are as we're talking through this.
Yeah.
That's ultimately the strategy. So let's take, you want to take the raw materials real quick? How did I get the additions to raw materials? Well,
so those are, I'm sorry, go ahead.
No, where did we get that one?
Those are our raw materials purchases.
Yep. So that's the key for that. You immediately start looking for purchases. Okay. In this case, he's got 410. 510. So we drop that in.
So remember, it's what you start with plus what you acquire, and in raw materials you acquire purchasing them.
Okay. So another way to think about this is acquire, if you can spell it right, or equippy. Apparently that's just equippy, but it's acquire. Okay. And then we've got this ending inventory.
Yep. Minus what you end with.
Yep. So then as a result, what gets transferred out in this case is going to be 450. And as you point out in this problem, that 450 is going to have a special name, and that's direct material. And then it swooshes up here, as Michael Jordan does in his Nike commercials that are now relevant again.
I'm better than LeBron.
Yeah, that's right. I understand. We can debate that. So we start with our direct material right there. Now, one of the challenges we have then is, okay, it looks like we're missing a lot of information because we don't know. So this was direct material. Do I know my direct labor, and do I know my manufacturing overhead? So those are the questions. So I need to know those two pieces. So let's go back and see. Thankfully, there's direct labor of 90,000. Okay.
Yep.
So I tend to drop that in here because I always tend to think about these things as direct material, direct labor, and manufacturing overhead. So those
Right.
three things just kind of fill that slot. And Eric, I really like the word that you use, which is acquire.
Mm-hmm.
So I'm acquiring those resources in an effort to complete the product and finish our product. And now,
Exactly.
this is a big one, all right? This is one that we see people make regular mistakes on. And this is the overhead amount, okay? And ultimately, what am I going to calculate for overhead here? Well, don't forget, you got three options, really. You've got the estimated overhead.
Yep, that's our original guess.
Yep. You got the actual.
Those are the bills and receipts.
And then we've got the amount that's applied, which is our updated estimate, right?
Correct.
So there's the 720. Now, we want to come back just a minute and say, how do we get the actual? Don't forget in this problem that all of this is considered overhead, okay? Actual manufacturing overhead. And I think we should probably draw your attention to one of these things is called indirect labor. And that always throws students off. You have to distinguish between indirect labor and indirect material when it comes to thinking about the product cost, okay? And so we've got these three choices. So what are you going to choose, Eric?
We're going to choose the applied.
Oh, okay. And why is that?
Because that's the basis on which we originally thought that we can just chip off a little bit of this overhead for every product.
Yeah, and so this is our updated estimate based on the actual activity we see.
Correct.
So that's where we get the 720. So you can always think about that as another swoosh, okay?
Yep.
But that's the key. And Eric, I tend to say that the applied overhead always goes into work in process. It's always applied. Is that fair, or is that too?
That is.
Okay.
That,
All right.
that allows us to smooth our costs. We don't have any wild fluctuations. It's just a really cleaner process for us.
Okay. So if you students are out there looking for rules, there's a rule. Okay. And so how do I get this number? Because I could understand it over here because it's just this, the 20 plus the 510 minus the 80 gave me the 450. The problem I have now is I've got a whole bunch of numbers. So what gets added together and then what gets subtracted, Eric?
Right. So your work in process is just the your materials, labor, and overhead.
Okay.
So the template remains the same. What we start,
okay,
which is our beginning work in process,
all right,
plus what we added during the period, which is our
okay,
overhead,
yeah,
minus what we end with, which is our ending work process.
Okay, and so then that leaves us with this amount that got transferred out, and that has a special name for us, right?
That would be called cost of goods manufactured.
Ooh, okay. So
COGM.
COGM, C-O-G-M. So that one's COGM, just like this was direct materials. Okay.
Mm-hmm.
So these things do have special names because accountants sit around and think about stuff that they can name because we don't have enough to do. Anyway, you get to swoosh again because what comes out of cost of goods manufactured becomes something that we can now sell. And so that's your 1,340,000. And just like the other ones, we're able to calculate the 1,200,000 that is getting transferred out here. And that too has a special name, and it is
cost of goods sold.
Cost of goods sold. Okay. So at that point, we need to come down and resolve a couple of other issues. One of those things is going to be how do we get our how do we get income? And then how do we deal with this idea of over or under applied overhead? Because one of the things we know is, as Eric pointed out, applied overhead is just another updated estimate. But eventually we have to compare it to what actually occurs. So that's where we are. So, oops, I forgot to highlight that. The actual overhead is going to be that 760, where I added up all of those overhead numbers.
Right.
So now we have everything on the board. And so all the playing pieces are here.
Right.
So if I know this 120, it's going to be cost of goods sold. And I'm going to put it in here.
Yep.
As always, sales minus cost of goods sold is your gross margin. One of the assumptions that we added was selling at administrative expenses. So we wound up with income of 380. And as another reminder, this is an absorption costing income statement. Although most of the semester we've looked at a variable costing income statement. Okay. But the challenge we have is down in here. You might remember Eric said, this is the one. This is the space where people tend to struggle. So Eric, when we think about over and under, we're comparing actual and applied, right? We're not going back to the original estimate. It's the actual results against our updated estimate, which is applied. Is that right?
Exactly.
Okay.
Exactly.
So our actual overhead was how much?
Our actual overhead was 760,000.
Okay. And then what we have to do?
Visualize it. If you
go ahead.
visualize it, I'm sorry. If you visualize a T account, when we have our actual overhead, when we pay our bills, that's going to be debited to our.
And what's this account called?
Manufacturing overhead, or manufacturing overhead control.
Okay.
Yeah.
All right.
So
when I apply overhead, where does it go?
The actual is going to be a debit, and the applied is going to be a credit.
Okay.
And at the end of the period, that's the net out to zero.
Okay, so this has to come out to zero, which means you're probably going to have some sort of adjustment either here or here to make this net out to zero.
Yep.
So if the actual is greater than the applied, I'm going to need an adjustment right here.
Correct.
If I've got an applied that's greater than the actual, my adjustment's going to be over here.
Yes.
Now, these two things have special names, right?
Correct.
So if actual is greater than applied, are we over applied or under applied?
You haven't applied enough, so you're
right.
Applied.
So remember, he's telling you, and this is really important, this one is a not enough piece.
Exactly.
If applied is greater than actual,
then you applied too much. You're
over. And so down here, you can think about it as too much. Not enough and too much. Okay? So those are the things you need to think about. So when we go back over here, we can see that our applied amount and our actual differ by 40,000, actual being greater. So in that case, it's going to be under applied.
Right.
We haven't applied enough.
Correct. Correct.
So this 40,000, what you're telling me is this 40,000 goes in one of these little adjustment boxes, right?
Right. Right. So we did not apply enough. We are under applied.
Okay.
So that means that we have to apply more.
Okay. So if that's the case, if I come over here and apply more, that's a credit.
Yep, exactly.
And the offsetting amount to that is going to be cost of goods sold.
Yes.
And so that's what you see up here in this income statement, because the 120 and the 420 remain the same. The challenge is I need to adjust cost of goods sold for over and under, okay? In this case, for the under applied. And as Eric said, that's going to get added to cost of goods sold. So I put the 40 in here. Now, this little piece right here, this can be mind bending, all right?
Yes.
Because on the one hand, you know, you're going, okay, I see the 40,000. Then for me, what I do is I do this first. So step one, I adjust my cost of goods sold. So my cost of goods sold now is going to be $1,240,000. And as a result, my new gross margin is $760,000. And so there's where the mind bending part comes in, because the adjustment increases my cost, but then what happens to my gross margin, Eric?
Our gross margin goes down.
Oh man. So they're going in opposite directions.
Yes.
And I have a really hard time remembering how that works. So,
Yeah.
I mean, it was that way when I took this course when I was 19. It's still that way now that I'm teaching this course at almost 66. So I think I'd have figured it out by now, but this is about the best I can do. And so at that point, calculating net income is pretty straightforward. And you'll see again the $40,000 difference between the unadjusted and the adjusted incomes. Anything else, Eric?
No, we've fully captured our total cost that we incurred with that adjustment, and yeah, we're all good.
Okay, go ahead.
You might want to consider, the students should consider, is when you see cost, then that is an expense. So even though when you see the costs are going up, that means that the expenses are going up, which naturally means that your income is going to go down.
Yeah, that's a good point. So just remember, when Eric was talking about this problem, okay, he said the toughest question was going to be revolving around this over and under applied. And make no mistake, that's coming on your final exam, because that's something we need to figure out if you guys have mastered that. So
We're not exactly psychic, but we can see this in your future.
Yeah, I can. Yeah, I can. And if I had to predict for all you Eric Valentine fans, I know he's going to put it on there. And if he does, then I am. So with that, we're going to leave you alone, and hope that helps you kind of finalize the last pieces of the material for the semester. Anything else, Eric?
No, good luck, guys. You've been working hard. Don't let up off the gas.
Exactly. Run through the finish line. If we've got any more sports analogies, we'll let you know. All right. Take care, everybody.
Bye.